Recording in progress.
Understand the need for foreign exchange rates. We need to understand what foreign currency is. Now, what is foreign currency? Foreign currency is what we use in international trade. What it means is that in international trade, where you trade with other countries, you are bound to use the other country's currency or a standard currency like US dollar, which serves as a middle currency between all countries. So in foreign transaction, that is international trade, which is all about transactions between countries. In foreign transactions, you need to acquire the domestic currency of the country you are trading with. You need to acquire the currency of the country you are trading with. If that be the case, what we are saying in essence is that for you to do a transaction with another country, you need to pay with the country's currency, the country's domestic currency. Now, normally we have two types of transactions. We have cash transactions, then we have credit transactions. Now, cash transactions could be said to be transactions that you meet the obligation immediately. While credit transaction is the transactions you defer the obligation. That is, you pay later. It could probably be in an hour's time, in 2 hours' time, in 3 hours' time, or a month, 2 months, and the rest. The same thing we have in foreign transactions. There are foreign transactions that we do what? That we, pay immediately. And there are those that we defer the obligation. And we call those ones spot rate and forward rate, respectively. We'll get there. We always fix a rate in foreign transactions. We fix a rate for foreign transactions. And that rate is what we call foreign exchange rate. And we need that foreign exchange rate because of these three things. Number one, to buy goods from another country, you are expected to pay in foreign currency. That is the domestic currency of that country you are buying from. So you have to exchange for that country currency to pay. And the only institution that deals with foreign currency is the bank. Is the bank. You can't get your foreign currency or domestic currency of another country just on the street. You can only get your own from the street, but the currency of another country, you can't get it from the street. So it means you go through the bank to buy. You buy the foreign currency and pay to your supplier. That is the need for foreign exchange rate. Another reason is when you are selling goods or services abroad, you need foreign exchange rate. You fix a rate in foreign exchange. So when your bank collects it, it will help you convert it into naira. The number 3 reason is when you are investing abroad, you need to acquire foreign currency to make such investment. Are we there? Let's take, for example, you want to, buy goods from Ghana. You pay with what? You don't pay with naira, you pay with cedis or US dollars. You approach your bank and buy. You buy from your bank and pay. And are bought and sold. Foreign exchange markets are operated worldwide by the banks. Now, because there are some currency in the world that does not really have, that does not operate in this worldwide market. They don't have banks that operate on such currency. They find it difficult to do what? To operate, to accept currency from such countries. There are some countries that banks cannot operate their currencies. So if you buy goods from them, you find it difficult to pay in such countries. So they are handicapped in such a way in foreign transactions, except you go through the US dollars, which is universally accepted all over the world, like I said. So I've told you that in foreign exchange, we talk about spot rate and forward rate. Talk about spot rate and forward rate. Now, like I said initially, I gave you an analogy of cash transaction and credit transactions in transacting business. Talked about cash transaction and credit transaction. I said the same thing applies in foreign transactions, international trades. So in the FS market, there is always a rate that is fixed, like I said. And that rate could be spot rate or forward rate. Now, what is spot rate? I told you when you settle immediately on the spot. When you settle immediately on the spot, we talked about spot rate. So in FS market, banks trade in currency, both on spot rates and on forward rates. So if you buy, I want to settle immediately, it means you are settling on spot rate. You are settling on spot rate. That is immediate settlement. However, practically, if you do a foreign transaction, the bank pays 2 working days after the transaction. Take for example, you do a transaction on Monday. The bank will settle, even though it's spot rate, it will settle, it is assumed it will settle on Wednesday. That is 2 working days after the foreign transactions. That is spot rate. That is spot rate. But for the purpose of examination, we treat such transactions as immediate payment, immediate settlement. We treat it as immediate settlement. What I'm just telling you now is that it is practical, but for examination purpose, spot rate is treated as immediate settlement. Immediate settlement. Then the forward rates will mean the opposite of it, where you have credit given to you. The opposite of it, where you have credit given to you. So we said that many times a forward rate will be that there will be a pre-agreed future date of a pre-agreed rate. That is, there is a future agreement. A future agreement for a rate that you will settle with. And this is what we call the forward rate. A future agreement of a rate that you will settle with. Let's say in 3 months, we'll settle at 200 naira or 1,500 naira. In 3 months, by now, you agree with your supplier that you will pay in 3 months' time 1,500. So whatever the price, whatever the rate, due to fluctuation, whatever the rate that is in the FS market, you will only pay at 1,500. That is forward rate, pre-agreed rate. So you will see that forward rate is a way of doing what? Hedging against risk, minimizing your risks, reducing your risks. When you want to reduce your risks, you use forward rate. Though it depends. It depends on the fluctuation of the currency. If it appreciates, you will lose. If it depreciates, you will gain. If your currency appreciates, you will lose. But if your currency depreciates, you will gain, because there is already a fixed rate that you will pay. So we have, in such situation, we have to quote a rate, and that brings us to exchange rate quotes. Exchange rate quotes. If you look at my slide, you will see me do what? Giving an example of exchange rate quote. So, in exchange rate quote, we talk about the price of one currency and the number of units of one currency that could be bought with 1 unit of another currency vis-a-vis. I want you to note that this time price is referring to the price of the foreign currency that is being sold. We have 2 methods of quoting exchange rates. We have direct method or direct quote and indirect quote. An example of direct quote can be seen on your slide. When we quote directly, it will be between Naira and Great Britain. Let's assume that Naira is 260 Naira and it can be exchanged for 1 sterling. So we express it as 260 Naira stroke 1 sterling pound. In Nigeria, we use this method, direct quote, regularly. We use this direct quote regularly. Now, what is indirect quote? This is the number of units of foreign currency that will be traded for 1 unit of domestic currency. You see, it's the reverse case of direct quote. It's the reverse case of direct quote, where the foreign currency is stated first before the domestic currency. And that will be using the same example as in A on the slide. All you do is just reverse the currency. The foreign currency is stated first, which is 1 pound sterling slash 260 Naira. This is an example of indirect quote and is also known as reverse quote. Example again. A direct quote in the domestic currency is 260 Naira stroke 1 pound. While in the view of the foreign currency country, that's UK, the indirect quote will be 1 pound exchanging for what? 260 Naira. So, what it means is we want to change the direct to indirect. Direct in Nigeria, using the same example previously, will be 260 Naira slash 1 pound, which is the same thing as saying 260 Naira can be exchanged for 1 pound. Indirect quotes in Nigeria will now be the reciprocal of what? The reciprocal of 260 stroke 1 pound. It will now become 1 pound stroke 260. That is 1 naira can be exchanged for 1 over 260. And 1 over 260 is 0.000385, meaning that 1 naira can be exchanged for what? 0.000385 pounds. What we are trying to do here is we are just measuring it for completeness, to break it down into detail. That is why we are doing 1 over 260, to break it down into detail instead of leaving it as a 1 pound slash 260 naira. So, if that is the case, what it means is that we will go and look at the next slide. We talked about strong and weak rates. Strong and weak rates. It is very important to, understand whether a country's currency is growing stronger or weaker against another currency. Because as one country's currency strengthens, the other country's currency weakens. So how do we understand is getting stronger against the dollar? And the dollar is weakening. At such situation, from 50 to Alternatively, you can also look at it that the dollar has strengthened against the naira, because previously $1 can buy 150, but now it can buy 160, meaning it has strengthened itself against what? The naira. Now you need to understand very well, when in exam, when you are looking at weakening or strengthening of a currency, because it is not certain that you will be giving naira in the exam. You might end up having to look at either Great Britain pound against US. So we are going to look at strong and weak rates under indirect quote using Great Britain pounds and US. In passing, Great Britain pounds, the UK always use the indirect quote most times. They use the indirect quote most times. So let's look at this example. The Great Britain pounds GBP slash dollar exchange rate changes from £1 slash $1.50, $1.50 to £1 slash $1.60. Now, what does it mean? What it means is that the pound is strengthened against the dollar. Previously, you can buy pound dollars, but now you buy with $1.60. What it means is that the pound has strengthened against the dollar, because you need more dollar to buy the pound now. Alternatively, it can be looked at that the dollar is weakened against the pound. Previously, you can buy previously 1.50 can buy £1. Now it takes 1.3 that the pound. Because we assume that one rate is used. That one rate is used. Now, like I said, we are assuming that in all these transactions, one rate is being used. However, in reality, or in practice, the bank does not just quote one rate. The bank quotes at least two rates. At least two rates. And this rate is what we call the bid and the offer rate. The bid and the offer rate. The bank buys at a lower rate and sell at a higher rate. What it means is that the bank bids at a lower rate and he offers at what? At a higher rate. So it's always in range. In the contract of buying and selling by the bank, they sell foreign currency at a stronger rate and they buy foreign currency at a weaker rate. So let's look at it this way. This is what we are trying to talk about. This is what we are trying to talk about. Let's use this example under direct quote, bid and offer rate. Under direct quote, bid and offer prices or rates. We are writing, a Nigerian company needs $10,000 to pay a US supplier. The bank current rates for Naira stroke US dollar are 150 Naira dash 160 Naira. What it means is that the company will need to buy US dollar in exchange for Naira in order to pay its US supplier. Now, what we are saying is that the bank will sell at what? At a higher rate, stronger rate. And that is 160. That is 160. So if that is the case, let's look at the board. So what it means is that let's look at the board. We will notice that the company will be buying from the bank at 160. 160 Naira times $10,000, and that will give us 1.6 million. 1.6 million. Now let's assume that the company end up doing what? Selling back that dollar immediately or subsequently to the bank. The bank will bid at the lower rate, which is 150 Naira. The bank will bid at a lower price, which is 150 Naira, and that will give us 1.5. What it means is that the company will be losing at the end of the day. And the loss will be 1.6 million minus 1.5. Like you guys said, it is 100,000 Naira. So the company will be losing 100,000 Naira. Now, I want us to look at the next example. And we are writing, a UK company needs $10,000 to pay a US supplier. The bank's current rate for sterling stroke US dollar, which is in bracket US dollar slash £1 sterling, are 1.5 dash 1.60. Now I want you to attempt this question. I'll give you 5 minutes to attempt it. Now, the bank sells the foreign currency at a stronger rate, and the stronger rate, like you said, is $1.5. So if that is the case, it will sell the US dollar to the company at 1.5, because the rate gives the bank more what? More pounds. And this is calculated as 10,000 divided by 1.5. And that will give us, like you said, 6,667 pounds. Now, assuming that the company, after buying and got $10,000 and got 6,667 pounds, he now wants to sell that 10,000. He now wants to sell that 6,667 to obtain $10,000. To obtain $10,000, the company is selling to the bank now. What it means is that the bank will be at what? The lower rate. And like we said, the weaker rate is what? Is 1.60. We have agreed on that. If the weaker rate is 1.60, what it means is that the bank will be doing what? Will be buying at 1.60, and that will give us 10,000 divided by 1.60, and that is equal to what? 6,250 pounds. If you notice, the difference between 6,667 pounds and 6,250 pounds is 417 pounds. What it means is that the company will lose 417 pounds in this, because 667 pounds received 6,250 when he sells, meaning he's going to lose 417 pounds. What we are saying is that head or tail, the bank gains in any transaction, particularly in foreign exchange. It's not that the bank only change. It depends on how you manipulate your transactions, particularly when you are using forward rate. The company can hedge against these losses. The company can hedge against these losses. That is, you can reduce your risk. The loss is a risk. So I want you to do this assignment and send it to my WhatsApp. Practice question 1. That's practice question 1 of ICANN Park. Now let's look at exchange rate and volatility, that is fluctuations. We come to understand that bank quotes exchange rates at which they are willing to buy and sell currencies in the FX market. Like I said previously, exchange rates are quoted as a number of units of one currency, which I said fluctuates, variable currency, in exchange of one unit of the other country's currency. And that is what we call the base currency. Like I said previously, the quote can be either direct quote or indirect quote. Direct quotes as used in Nigeria and mostly other countries, or indirect quote that is always used by the UK. So the exchange rate is very, very volatile because it changes. If you ask those that deal in forex like the banks and some individuals that predict change to make gain, that is foreign exchange marketeers. We have some people that